So let's just talk about this bounce attempt, I guess we could call it, Joe. It's understandable to me why it has begun entering this week in a logical spot, which is a 5% decline in the S&P 500. We got to almost to the 200-day moving average. Seasonal factors start to turn better in the second half of March. And, of course, you have this residual hope there that we've reached the point of maximum uncertainty in Iran. Maybe oil has seen its highs. Still something to prove, I would argue, though, for the rally itself. What are you looking at?
Well, I think what's most important right now is that we break the correlation between higher oil prices and lower equity prices. And the appearance over the last several days is that, in fact, we're doing so. I also believe that we've established where that breaking point for equities is as it relates to oil. So the equity market does not like oil prices above $100, above $105. That seems as though to be the breaking point. It appears as though the equity market is comfortable, as it was in 2011, 2012, and 2013, when the average price of oil in each one of those 3 years was $95. The market was comfortable in that environment with oil. So I think if we just basically elevate the range of oil to 85 towards 100, I think we could live in that world. It's when oil spikes well beyond that the markets don't like it.
Steph, I mean, arguably in the early 2010s, the S&P was at 13, 14 times earnings. Maybe not as much was expected out of stocks. But how are you reading what the market's done this week, where it's tried to find a little bit of a foothold? Because you actually have seen some of the laggard groups, try to make a little progress this week.
Yeah, and that's exactly where I want to go. Actually, value outperforming growth today and yesterday. Banks actually finally catching somewhat of a bid. We have to watch that, but they've been a laggard and something that we all have been watching because of the private credit concerns. Energy, oil stocks, some industrials are doing well. So it's more of the cyclical story today and some part of yesterday. And I think, Mike, that's because in the face of uncertainties about war and the timing, the economy is holding up. I mean, you got the Atlanta Fed tracker at 2.7%. Weekly jobless claims last week were really good. I expect them to continue to be very low in the 215 range to 220. Retail sales, core was up 4%. ISMs, 2 months in a row, over 50. So that's the first time that's happened in 3 years. And industrial production now up for the 4th consecutive month. So in the face of all this, the economy is hanging in. A lot of it is AI driven, and that's a nice tailwind, and that's going to continue. But the consumer also is doing their part. Yes, it's K-shaped, but they're doing their part. When you listen to Bank of America, when you listen to MasterCard, when you listen to Visa, last week they were at conferences, every one of them said the consumer is doing just fine. And that's a big part of our economy, so I keep a close eye on it. But I like that, at least the follow-through on the cyclicals based on the data that we're seeing.
I guess the question is going to be, Josh, whether that good, encouraging evidence is going to run up against the potential that we have more friction in the story when it comes to what oil prices are doing, some consumer confidence issues since we're 2+ weeks into this Iran campaign. I do want to get your take, though, Josh, on the general setup here, because it's hilarious how we always talk about the S&P 500 in one of these sideways phases and say, look how resilient it's rotating away from danger. I've said it a million times. And then we get to a point when the decline starts to wear on the index, and everyone says, oh, but we haven't seen the flush. It's been too resilient. We need to see people give up on this and to create some kind of a slingshot effect. So where are you looking for evidence that the market either has the makings of that kind of a comeback, Josh, or we're still waiting?
I think the modern investor is just different from what a lot of us are used to. Mike, you're a veteran of the markets like I am, so is Stephanie, so is Joe. But we have to acknowledge the fact that today's investor, they sort of get it like, oh, if I sell when the S&P falls 5%, I'm going to look like an imbecile in like 3 weeks, so I'm not going to do it. And instead, what we're seeing is, I'm going to use the word rotation for the millionth time, but I think it's the most important concept. Investors are flocking to the stocks that are going up right now. And, look, the best stocks in the market concept is, where is the real strength? And think about the stocks that Joe has been talking about, I've been talking about, Stephanie, Chevron, Exxon, making record highs today. Look at the refiner complex, Marathon, Phillips 66, and of course Valero. And even like the oil services names, those did get hit a little bit harder during the Iran episode, but they're all right back. Baker Hughes, right back. These things are in substantial uptrends. So I think investors are like, all right, I get it. We're not playing the software game this year. We're not playing the data center game as much this year, maybe in the industrials, but not in the actual Mag 7 stocks. But this game, this is a great game. And you're seeing it everywhere. And you can't tell me that's just retail. I know the pros are doing it too. The other thing is, the only real panic that we're seeing, it's actually funny, it's in the private market. How do you panic in the private market? It's like a mime. Like, how do I get out of this invisible box? It doesn't even show up in the junk bond ETFs. So yeah, we have concerns. Yes, there are issues in the market. There are question marks, but I think the modern investor, at least for now, has done a great job rotating, moving to where the money is going, and ignoring the things that historically would have put them on the sidelines, even 3 and 5 years ago. And they just don't race to the sidelines.
I mean, did we have a modern investor 11 months ago, Josh, when everybody was liquidating everything at the lows?
I don't know that everybody did that. If you look at Vanguard data,
you can look at the flows.
If you look at Vanguard data, Charles Schwab data, you look at Fidelity data, 401k flows never stopped, and that's the real money. So seeing $20 billion come out of an SPY and then go right back in 2 months later, I don't really think is what the main body of investors are doing. Look at the 401k flows. They never budged, nobody sold, and I don't think they'll do it this time either.
We magically got 20% down with nobody selling, I guess. Okay, in a flash. Brian, what are you thinking about in terms of field position for the market here? And I'm looking at an S&P. We're at the December lows. Yes, we're up off of last week's bottom, but it doesn't seem as if there's a sort of a tentative nature to this comeback. And maybe that's to be expected because there's a pretty wide range of outcomes we're having to entertain here.
No, I think that's right. But I also think, too, to double back on what Josh was saying, take it from a guy that's been doing this since the late 80s. We were always looking for the big flush. The big flush rarely happens. And then people typically, especially in this market, don't get in fast enough. I think that's right in terms of the moves that we've seen so far. But I think what the market's saying is kind of what we teed up when we talked about our year ahead piece for 2026, when we talked about the market is clearly transitioning from a multiple expansion market to an earnings driven market. Stephanie talks about earnings all the time. We always talk about resilient. But from a sector by sector basis, the quality of earnings in 2026 is very good. The consistency of earnings growth is very good. I think we tend to make too much out of trying to catch the bottom in some of these themes, quite frankly, Mike, with respect to software and trying to catch the falling anvil, as I learned a long time ago, that old saying. But I do think what's happening today is a very constructive day. Very constructive day, especially considering the broadening out across board. Small cap stocks are working. Stephanie talked about financials. We think financials from an earnings perspective are really going to be driving things the second half of the year. And we actually continue to believe both institutional and private wealth clients are way underexposed financials. And we really think that's an area where we're going to see a lot of gains.
Yeah, I'm not so sure about that, Brian. I think financials were the favorite sector coming in to 2026. All the
I don't agree with that.
Funds.
The favorite sector? No way was it the favorite sector. Everyone was trying to play healthcare because healthcare in the fourth quarter, Joe, was the momentum play. I think financials actually were outperforming well before the fourth quarter. Everyone was trying to think more value side of things. And well, industrial, if you go back and look at some of the tape and on this show in particular, everyone was trying to chase energy, healthcare, utilities, consumer staples. They were much more defensively positioned. Financials, I think, at the end of the day, though I will say the money center banks, but everyone's missed the move in the small cap financials, which has been actually quite good. So I don't agree with everyone was loving financials
We're just going to disagree. It'd be better if you were here and we could disagree in person. But if you look at a lot of the momentum funds at the end of 2025, they were all significantly overweight. I run one of them, financials. You had a lot of people that were coming on the shows and talking about financials being the place to be, banks themselves. And I think fundamentally a lot of those conditions are still in place, but you are seeing a recalibration as in terms of sentiment and positioning for that sector itself. I do agree with you on where we were at the end of 2025, where the market did its job in getting in front of the flush in software, the flush in the private equity names, and really pivoting towards the healthcare names, the defensive names, the material names, the REITs that so far have exhibited a strong degree of resiliency.